How's that affecting real estate? Well, this chart, the bars here show net absorption, just the increase in occupied office space across the major markets across Asia Pacific. And you can see how after quite a strong recovery in 2010 and the early part of last year, that increase in demand fell away quite markedly, notably in China and India, which had been major drivers of this expansion during 2011. Occupiers, particularly multinational companies who have direct operations in Europe and North America, are very concerned about what might or is happening to their businesses. And the growth dynamic here in Asia, even though longer term everybody's still very confident about the region, the growth dynamic has certainly slowed and shifted. Many domestic companies that don't have those same concerns are still much more aggressive. But multinationals, particularly those in finance and directly related sectors, are somewhat on the back foot. Everything that we hear is about cost saving, it's about efficiency, it's about decentralizing, it's about finding new locations where we can operate cheaper or more efficiently. Big decisions, even those, unless they're very directly bottom line enhancing in the short term, big decisions have generally been deferred. We certainly saw that in the latter part of last year. We'll have to wait and see whether they start to pick up again and we actually see many deals being completed. But generally, occupiers are cautious about committing to big capital decisions. They're looking very closely, however, at lease events coming up to see how they can take advantage of the situation and of the markets. It's not all gloom. Insurance, commodities, obviously very important here in Australia. The retail sector generally across the region are still in growth and expansion mode, albeit even they're probably more cautious than we were seeing during certainly the early part of last year. So if we look at what's happening to rental movements, these are just the quarter-on-quarter movements, the quarterly movement in rents in the final quarter of last year. But you can see that whilst there are some markets that have still been seeing growth coming through, particularly China and India, particularly in Beijing, which has seen very strong growth, and notably in Perth, there are also many more markets that are now either stable or actually seeing declines, in some cases quite significant, and some major markets in there, Hong Kong, Singapore, Tokyo, seeing prime rents still declining. And that feeds through into our rent index for the region as a whole, and you can see the pattern is pretty similar in markets around the world. The recovery that we saw in demand for good quality space in the best locations, the prime space, actually was leading to a recovery of varying degrees and timings, but a recovery in all the major regions. But that's very much slowed, particularly in Asia Pacific, where we did see some very strong growth in parts of last year. But that momentum very much coming out of the market. So that's the context from an occupational point of view. What about in the capital markets? Well, a couple of weeks ago, there was a comment made in a publication from Bank of America Merrill Lynch, which I thought summarized things nicely. They said, risk off is now off, but risk on isn't yet on. In other words, the really negative sentiment was starting to come off. No one wants to be caught in a very defensive risk-off position when things start to recover. But people still don't have that confidence that actually we're going back into a more dynamic growth environment from a general investment perspective. Investors across the investment spectrum are really at the moment in the middle of what's described as an ugly contest. If you've got money to place, there are really very few places that you can look that look fundamentally attractive. In that context, truly prime property really does look relatively attractive at the moment. The spread between property yields and bond yields is at very high levels. Bond yields, the market is just awash with virtually free money at the moment. The equity market remains volatile. And so prime property is attractive because of a number of its inherent fundamental characteristics. It has a contractually guaranteed rent, which occupiers do tend to pay whilst they're still in business. Often in many parts of the world that rent is indexed, so that if the inflation starts to come through, we start seeing improved incomes. There's a lot of debate about whether property really is an inflation hedge or not, but a lot of people certainly believe it is, and it does have some of those characteristics. And if there is a recovery, or when there is a recovery that comes through, obviously rents and incomes start to rise, so it's good defensively. The key thing is, prime property around the world with the possible exception of here in Australia, prime property around the world, and certainly in Asia, really doesn't look cheap. In fact, it looks expensive. But that's because there are a lot of people recognizing these qualities, and that's the space they want to be in. And it's the same with the other defensive type plays, gold, Swiss francs. You know, the types of assets that investors like at times like this are expensive at the moment. Just bear in mind the type of sentiment that we have in the wider market. This is the German one-year bond yield. And you can see back in the middle of last year, somewhere up around 1.5%. When the trouble hit, those bond yields have plummeted. In the early part of this year, they turned negative. Negative yields on one-year bonds. The same thing happened with various US treasuries. What that means is that people are paying the Bundesbank to hold on to their money simply because they're relatively confident that at least the Bundesbank will give their money back at the end of the year. In that kind of investment environment, it's not surprising that we're seeing some what look like pretty aggressive prices paid for prime secure property that's yielding, even in many parts of Europe, the prime market's yielding in the 5s or low 6s. So investors are very wary, but where they're buying is that very prime segment. Anything that's secondary is much less popular, but the good quality, and quality now defined by covenant, by the income stream, good locations, in good liquid markets that people can trade out of if they need to. And I have to say that is one of the very big attractions of the market here in Australia, that it is liquid, it is transparent. That's where people are focused. Unlike in the secondary areas of the market, where shorter leases, development plays, that kind of thing, they're much more dependent on the outlook for the occupational side and the global economy. And as a result, far less interest, or where there is interest, it's priced quite much more loosely, people demanding a risk premium for buying those assets. In terms of what all this means for flows of capital around the globe, I mean, you would think that as there is a recovery coming through, as and when it happens, that we'll see money coming to Asia, and clearly we'll see some of that. But I think we ought to be aware that there are going to be many very attractive secondary value-add, opportunistic type investments coming through in the markets in Europe and North America. So expectations that there's going to be a huge flood of money coming into that space, I think, are perhaps unfounded, although it is true that there are a lot of Asia funds out there. There's a lot of capital being raised looking at Asia that's still finding it difficult to get into the market. So certainly there is demand there. So what's been happening to capital values? Well, around the world, and again, particularly here in Asia Pacific, where we saw that weight of money looking at the prime sector, driving down yields and some rental income growth coming through, that momentum has again started to ease in Asia Pacific. Capital values just ticked slightly negative in the final quarter as yields moved out and rents came off in some of those major markets. And again, I think this is very much what we're going to see, softness during the early part of this year, and we have to wait and see what some of the bigger political and economic issues deliver to us to see whether or not sentiment will improve. But it quite clearly is going to be a relatively tough year. In terms of transaction volumes, as an analyst, this is one of those charts that we absolutely hate because it shows exactly the opposite of what I think it should be showing. Everything that we see and hear when we're talking to investors and to our colleagues is that sentiment very markedly weakened in the investment market as well, the property investment market in the latter part of last year. That said, we saw a number of very big transactions going through, some portfolio deals in Japan, in China, some big transactions here. We've also seen a flow of deals that were really in negotiation during the course of 2011 that did complete towards the end of the year.